Our next guest is in charge of corporate credit at Goldman Sachs, advising companies on their multi-billion-dollar financing plans. Jonny Fine, Goldman Sachs head of investment-grade syndicate, right here at Post 9, as you often do, which we always appreciate. I don't know. I guess we start with Powell. Any reaction to sort of what he had to say in terms of an interpretation as to whether perhaps we don't get another cut as soon as we think?
So I think we'll get another cut in the December meeting. But then I think as we move into 2025, there's so much uncertainty with respect to the new administration's policies and how that might impact inflation that I think there's every chance that they could pause quicker than necessarily some forecasters or the markets anticipate. I still think that the trend's intact. It's really just a case of where does this easing cycle end? And really, does it look like a traditional easing cycle or does it look quite different?
Right. All right, so we'll role play here. I'm a big corporation. I've got a nice credit rating. I'm a Goldman client. And I'm like, Jonny, when do I issue? I got to do some refinancings. I know they're coming up maybe next year, but I've got some flexibility. And long term, short, what should I do?
Well, it's hard to look the gift horse in the mouth in terms of the financing environment that exists today. So we'll talk about both the spread component as well as the base yield component. Spreads in terms of IG credit are at multi-decade tights or very close to those levels. So that component, I think, is more or less a no-brainer in that you'd want to take advantage of the spread environment that exists today, as well as the execution conditions, which have been very affable all year.
There's been a good liquidity and everything else.
Terrific
right?
liquidity,
yeah.
All the dynamics that we look for in terms of book building, subscription, follow-through demand, etc. They've been excellent.
Right.
But then you talk about the base rate. Now, we've had a very nice rally in longer yields since we had the spike post-election. And so really, since Scott Bessent was nominated as Treasury Secretary, and all of a sudden there tends to be a perspective by the market that will have more fiscal discipline than we had envisaged in a sweep scenario, that's created downward pressure on term yields. And so, of course, we're not at the levels that we had during QE, but when we look at and evaluate the levels of, for example, 10 and 30-year treasuries, we actually think that they're reasonably attractive to consider locking in an environment where, as we mentioned, there's a lot of uncertainty as to what the direction of front-end rates is from here, and I would expect those front-end rate directions to ultimately determine whether the long-end trades up or down from here.
Right, although we can all interpret what may happen, but we don't know when it comes to the Department of Government Efficiency or potential tax cuts. I mean, there are plenty of things conceivably next year that could send us in a different direction when it comes to at least the sentiment around rates.
100%. So I think what that means is, and I think you're saying it well, is with that uncertainty as to the direction of front-end yields, with the environment that we have now, it's a pretty attractive environment to consider financing. We've had a more attractive post-election financing environment than we had anticipated going into the election. It's likely that we're going to finish the year with continued strong financing tailwinds. So as we roll forward into 2025, I would expect, similarly to what we saw this year, a large number of issuers to bring forward their financing plans and take advantage of what they see as being very attractive financing conditions.